Hello everyone, today I am going to explain about income tax. First of all, let us see what is tax. Tax is the compulsory extraction of money from people by an authority to be spent for the common benefit of the society. As we all know, no government can function adequately without proper finance. So, tax is the major source of revenue to the government. Let us see the features of tax. First feature of tax is that it is a compulsory payment and hence a refusal to pay tax is a punishable offence. Every citizen of India is liable to pay tax if their income exceeds the prescribed limit under the Income Tax Act 1961 and the Finance Act passed by the Parliament during the month of February every year. Second feature is that there is no direct quid pro quo between the taxpayer and the tax imposing authority. Hence, the taxpayer cannot claim immediately any benefit against the tax paid by him. Third is, it is a payment for an indirect service to be rendered by the government to the community because the government utilizes the amount collected as tax for the development of our country. Fourth is that the time and mode of payment of tax is determined by the tax imposing authority from time to time. These are the features of tax. Next, let us see the objectives of taxation. First objective of taxation policy is generation of revenue to the government. It is a major source of revenue to the government and it is important to generate more revenue for the government. By utilizing this revenue, the government undertakes various developmental activities for our country. Second is that prevention of concentration of money in the hands of a few. The government can charge more tax on the wealthy people and can utilize this amount for the benefit of our society. Through this way, the government can redistribute the wealth concentrated in the hands of very few states or in the hands of very few people and utilize this for the common benefits. And third objective of taxation is increasing the habits of saving among the people. Government provides tax incentive in order to divert the idle money to productive investments. So, tax exemptions on the investments in life insurance, mutual funds, national savings certificate, etc. increases the savings habit among the people. And fourth is that speedy economic development. More tax means more revenue and more revenue leads to the rapid economic growth of a country. Government utilizes the amount collected as tax for the development of a country. Next is the generation of employment opportunities. More tax means more investment and more investment leads to the generation of more employment opportunities and through this the government can eradicate the problem of unemployment in our country. Next, let us see the classification of tax. Tax can be classified into two categories. First one is direct tax and second is indirect tax. What is direct tax? Direct tax means there is no intermediary between the taxpayer and the tax imposing authority. The taxpayer directly pays the amount of tax to the government. He himself assesses the tax liability and finally remit the amount to the government. And income tax is the only direct tax that prevails in India. Second is indirect tax. Indirect tax means there is an intermediary between the taxpayer and the tax imposing authority. The government collects the tax through an intermediary like trader, manufacturer, service provider, etc. There is an intermediary like trader, manufacturer or service provider between the taxpayer and the tax imposing authority. All indirect taxes in India including excise duty, service tax, VAT, sales tax, etc. were merged into a single tax known as Goods and Service Tax with effect from 1st July 2017. So, these are the classification of tax, direct taxes and indirect taxes. Income tax is a tax on the annual income of a person. Every person whose income exceeds the prescribed limit under the Income Tax Act 1961 and the Finance Act passed by the Parliament need to pay tax on their income. Income Tax Act 1961 and the Finance Act passed by the Parliament during the month of February every year fixes the rates of tax applicable for that assessment year. Next, let us see what is assessment year. Assessment year is defined as a period of 12 months starting from 1st April and ends on 31st March every year. And the income earned during the previous year is assessed for tax during the assessment year. Next, previous year. Previous year is a period of 12 months starting from 1st April and ends on 31st March every year. Previous year is the year in which the income of the assessment year is earned by the SSC. These are the two most important terms in income tax. Next, let's see the charging section. That is, Section 4 of the Income Tax Act deals with the charging section. Section 4 of the Income Tax Act is the charging section and it confers the government the power to levy and collect tax from the people. There are certain principles relevant to the collection of tax from the people. Income tax is an annual tax on income. It is calculated on the total income of a person. Income of the previous year is assessed for tax during the assessment year based on the rates applicable for that assessment year. Finance Act passed by the Parliament during the month of February every year fixes the rates of tax applicable for that assessment year, and tax is charged on the income of a person as defined under Section 2. Tax is charged on the total income of a person. Wherever possible, income tax must be deducted at source or paid in advance. Next, let us discuss about income according to Section 2 of the Income Tax Act. Income means any monetary benefit derived from a definite source, and it includes profit and gains. Then dividend received from a company comes under the category of income. Voluntary contribution received by a trust, the value of any perquisites or profit in lieu of salary, any special allowance or benefit received by the employee. Employer's contribution towards the employee's provident fund can be also included under the category of income. Any compensation received under keyman insurance policy, any allowance granted to the SSC either to meet the personal expenses or to meet the official expenses relating to his duties can be considered under the category of income. Then value of any benefit or amenity, whether convertible into cash or not, can be included under the category of income. The value of any benefits or perquisite, whether convertible into cash or not, any sum whether received or receivable in cash or in kind under an agreement for not carrying out any activities. Then any allowances other than the salary of the SSC, and the income earned during the transfer of capital asset can also be comes under the category of income. Then income from other sources like interest on securities, winnings from lotteries, winnings from crossword puzzles, winnings from card games, winning from horse races are also comes under the category of income. These are the important items to be included under the category of income according to Income Tax Act 1961. According to Income Tax Act 1961, the heads of incomes are classified into 5 categories. First one is income from salary. Second is income from house property. Third is profit and gains of business or profession. Then capital gain. And fifth head is income from other sources. Income from salary includes the incomes relating to the salary. That includes retirement benefits like voluntary retirement scheme, retrenchment compensation, pension, perquisite. Perquisite means the benefits provided by the employer to the employee other than salary is known as perquisite. Perquisite also comes under income from salary. Then any other benefits related to the salary provided by the employer to the employee comes under the category of income from salary. Second is income from house property. Income earned by the SSC through letting out a building comes under the category of income from house property. Then profit and gains of business or profession. Profit and gains of business or profession includes the incomes earned through conducting business activity, or the income earned by the professional also comes under the category of profit and gains of business or profession. Then is capital gain. The gain arising from the transfer of capital asset is known as capital gain and it is taxed under the head of capital gain. Income from other sources includes all income that cannot be taxed under other 4 heads of incomes are taxed under the head income from other sources. So these are the 5 heads of income according to Income Tax Act 1961. For the purpose of tax, we can classify the individuals into 3 categories, and based on these 3 categories, the income tax is charged on their income. The income tax slab for the year 2020-21, that is for the assessment year 2021. In the year 2020-21, the income earned during the 2019-20 year is taxed. According to income tax, we can classify the individuals into three categories for the purpose of tax. First one is individuals up to the age of 60 years. Second is individuals between 60 to 80 years of age, that is known as senior citizens. And third category is individuals above 80 years, super senior citizens. In case of individuals up to the age of 60 years, income up to rupees 2,50,000 is exempted from tax. For individuals up to the age of 60 years, no need to pay tax if their income is up to rupees 2,50,000. 2,50,000 to 5 lakh, they need to pay 5% tax on their income. If their income is between the tax slab of 5 lakh to 10 lakh, they need to pay 20% of tax. Above rupees 10 lakh of income, they need to pay 30% of tax. In case of individuals aging between 60 to 80 years of age, up to rupees 3 lakh, their income is exempted from tax. From 3 lakh to 5 lakh, they need to pay 5% of tax. 5 lakh to 10 lakh, they need to pay 20% of tax, and above rupees 10 lakh, they need to pay 30% of tax. In case of individuals above the age of 80 years, up to rupees 5 lakh, no need to pay tax, it is exempted from tax. From 5 lakh to 10 lakh, 20% of tax is applicable, and above rupees 10 lakh, 30% of tax is applicable for them. Next is surcharge. Surcharge is levied as an additional tax on those who have income above rupees 50 lakh. And then health and education cess shall be levied at the rate of 4% on the tax, including surcharge. Every person need to pay health and education cess at 4% on their tax liability. So these are the income tax slab according to assessment year 2020-21, and the Finance Act passed by the Parliament every year during the month of February fixes the tax rate applicable to the individuals. That's all about basics of income tax. Thank you.